Asalam-o-Alikum. In macroeconomics class, we will discuss monetary policy and fiscal policy. Monetary policy. Credit control measures adopted by central bank of a country. There are two instruments. One is quantitative and the second one is qualitative. We will discuss both of them one by one. Number one is quantitative measure of credit control. In this instrument, we discuss some measures like open market operation. In open market operations, sale and purchase of security in the money market by central bank. The second one is the repo rate. We already discussed repo rate, reverse repo rate or bank rate in the policy rate class, but we will discuss these measures in the monetary policy as well because these are the quantitative measures. RBI or the central bank charges to commercial bank for short-term loans, increase in the repo rate, decrease in the money supply. Bank rate. To reduce money supply, bank rate is increased. RBI charges bank rate to commercial bank for long-term loan. Reverse repo rate, RBI borrow from bank short-term loans at reverse repo rate. In this case, bank rate is more than repo rate and repo rate is greater or more than the reverse repo rate. Cash reserve ratio. It is a percentage of money which a bank has to keep with RBI or the central bank in the form of cash. SLR is greater than CRR. CRR means cash reserve ratio and SLR are the statutory liquidity ratio, which is the percentage of money which a bank has to keep with itself. It cannot give loan out. Now we will discuss some qualitative measure of credit control. Number one is rationing of credit. Priority sector should be given preference in lending loan from others. The second one is margin requirement. It is the difference between market value of security and maximum loan value. Whenever the market value of security is more than the maximum loan value, so at this point margin requirement increase and it will decrease the amount of loan and thus the money supply. So the next one is moral suasion. Moral suasion means the central bank or the RBI has been sending letters periodically to the commercial bank for requesting them to cooperate with it. Otherwise, they will take the direct actions. Like it refers to the direction issued by the central bank to the commercial bank regarding their lending policies. How monetary policy can control inflation? There are two types of money policy. Number one is dear money policy. In this case, increase in bank rate, cash reserve ratio SLR can decrease the money supply. To reduce the money supply, open market operations, for example, treasury bills, bonds, etc., are sold in the open market. The second one is the cheap money policy. In the cheap money policy, it is used during in deflation. In this case, rate or decrease, open market operation are bought by government of a country or by central. Now we will discuss some points of the fiscal policy. It is the revenue and expenditure policy of a government instrument or government expenditure taxes. During inflation or in the boom period, taxes are increased and expenditure are low. In case of the surplus budget, government revenue is more than government expenditure. On the other hand, during deflation or during the depression period, expenditure are more than taxes. It is totally opposite to the boom period. In this case, government expenditure are more than deficit budget government revenue. Whenever taxes increase or expenditure decrease, it is the surplus budget case where government revenue is more than government expenditure. On the other hand, whenever government expenditure are more than government revenue, so the budget comes toward the deficit budget. And we also discuss crowding out effect. Whenever we talk about the crowding out effect, we uh, discuss about the private expenditure or the private sector. So, private sector are out of the market. Reduction in the private expenditure caused by the increase in government expenditure through deficit budget. Government expenditure more than aggregate demand, more than interest rate, and private investment will decrease during the crowding out effect. Three forms of discretionary fiscal policy. The first one is change taxes and constant government expenditure. Change in taxes means government if government change in taxes and keep the government expenditure constant and want to change the inflation at that time if the inflation is high in the country and they want to control, so they if they adopt this policy where they only focus on taxes, so it will take time to reduce the inflation. On the other hand, if government want to change in the government expenditure and keep the taxes are constant, so it will also take some time to control the inflation. On the other hand, at the third point, if government want to change in both or variation in both change in taxes and change in government expenditure, so there is strong possibility to control the inflation in a near future. So these are the forms of the discretionary fiscal policy. We will discuss the difference between the fiscal and monetary policy in the next class.